Here's something most freelancers never think about until tax season blindsides them. How you pull money out of your business isn't just bookkeeping. It's one of the biggest tax levers you have, and in 2026, it matters more than ever. The IRS Social Security wage base just jumped to $176,100. That means if you're running as a sole proprietor and you're clearing six figures, you're paying full 15.3% self-employment tax on every dollar up to that threshold. That's not a small number. On $120,000 of net profit, you owe roughly $16,956 in self-employment tax alone, before federal income tax even enters the picture. According to the IRS, self-employment tax is the single largest tax burden for most self-employed individuals. There's a smarter playbook here. Owner's draw, W-2 salary, and S-Corp distributions each hit your tax bill differently. By the end of this video, you'll know exactly which structure fits your income level and what to actually do about it in 2026. Why this decision costs freelancers thousands. Let's start with what's actually happening when you pay yourself. When you work a traditional job, your employer splits FICA taxes with you. They pay 7.65% and you pay 7.65%. That's the Social Security and Medicare split. When you're self-employed, you are the employer and the employee. You pay both halves. That's the 15.3% self-employment tax that shows up on Schedule SE. The IRS breaks it down as 12.4% for Social Security on wages up to $176,100 in 2026 and 2.9% for Medicare on all earnings, no cap. Cross $200,000 in net earnings as a single filer, and you owe an additional 0.9% additional Medicare tax on top of that. There is no employer to share the load. That's the core problem this video is solving. Here's what most freelancers get wrong right off the bat. They think paying yourself is just a cash flow decision. When do I move money? How much do I move? It's not. It's a tax structure decision. The method you use to pull money from your business determines whether that money is subject to self-employment tax, payroll tax, income tax, or some combination of all three. Getting this wrong costs the average high-earning freelancers thousands per year. The Tax Foundation estimates that self-employment tax is effectively a 14.13% marginal rate increase on top of income tax for sole proprietors. Once you factor in the deduction for half of SE tax, the effective hit is still brutal. So let's go through each method clearly. Owner's draw, the default, and its real cost. If you're a sole proprietor or a single-member LLC taxed as a disregarded entity, you use an owner's draw. You just transfer money from your business account to your personal account. There's no payroll, no W-2, no withholding. It's the simplest method, and that simplicity comes at a price. Here's how it works at the tax level. The IRS doesn't tax you on your draws, it taxes you on your net profit. So if your freelance business earns $100,000 and you only draw $60,000, you still owe taxes on the full $100,000. That matters. A lot of new freelancers learn this the hard way. They leave money in the business account thinking it's safer and then owe taxes on money they didn't even spend. That's a quarterly estimated tax problem waiting to happen. On a sole prop with $100,000 net profit in 2026, your self-employment tax is $14,130. You can deduct half of that, $7,065, which reduces your adjusted gross income. So your taxable income for income tax purposes drops slightly, but you're still on the hook for the full SE tax. Add federal income tax at the 22% bracket for a single filer, and you're looking at a combined effective rate well above 30%. Your actual rate will depend on your filing status, deductions, and other income sources, but the SE tax piece is unavoidable in this structure. Owner's draw is the right default when you're under about $40,000 in net profit. Below that threshold, the administrative cost and complexity of running payroll or electing S-Corp status typically outweighs the tax savings. Above $40,000, you need to start doing the math on what comes next. Paying yourself a W-2 salary. If you've elected to have your LLC taxed as a C-Corp, or if you're a solo shareholder in a C-Corp, you can pay yourself a W-2 salary. The business withholds income tax, Social Security, and Medicare, just like any employer would. The company deducts your salary as a business expense. You receive a W-2 at year-end. Here's my take. Paying yourself a W-2 salary through a C-Corp structure rarely makes sense for most freelancers at the income levels we're talking about. C-Corps face double taxation. The corporation pays tax on its profits at the 21% flat corporate rate. Then you pay personal income tax on any salary or dividends paid to you. Unless you're building a high-growth company you intend to sell, or you have specific reasons tied to benefits and retained earnings, C-Corp status adds complexity without enough tax relief for a typical solo operator earning under $500,000 annually. There is one W-2 scenario that does matter for freelancers. If you elect S-Corp status, you are required to pay yourself a W-2 salary. That brings us to the structure most serious freelancers need to understand. The S-Corp salary plus distribution split. The S-Corp is where the real tax lever lives for freelancers earning above roughly $50,000 to $60,000 in net profit. Here's the mechanism. When your LLC is taxed as an S-Corp, you become a shareholder employee.
You pay yourself a reasonable W-2 salary, then after payroll taxes are handled on the salary portion, any remaining profit can be distributed to you as a shareholder distribution. That distribution is not subject to self-employment tax or payroll tax. It flows through to your personal return and is taxed as ordinary income, but it skips FICA entirely. Let's run the numbers with a real example. Say you're a freelance designer making $130,000 in net profit in 2026. As a sole proprietor, you owe self-employment tax on all $130,000. That's roughly $18,371 in SE tax minus the deduction for half, leaving you with a net SE tax hit of about $16,534 after the adjustment. Now run the same income through an S-Corp. You pay yourself a reasonable salary of $65,000. Payroll taxes on $65,000, about $9,945 total, split between you and the S-Corp, which you own, so you're funding both sides. That's $4,972.50 each. The remaining $65,000 comes to you as a distribution. No FICA on that $65,000. Rough SE tax savings approximately $8,400 annually. You'll spend $500 to $1,500 on payroll software or a payroll service, and potentially $1,000 to $2,000 on an accountant who handles S-Corp returns. Form 1120-S is not something you want to do yourself. Net savings still lands somewhere between $4,000 and $7,000 per year, depending on your situation. That compounds fast. This math shifts based on your income level, filing status, and whether you're also making retirement contributions, but the directional conclusion is the same. Above $60,000 in net profit, the S-Corp conversation is worth having seriously. What most freelancers get wrong about reasonable salary. Here's where people mess this up and where the IRS pays close attention. To get the S-Corp distribution benefit, you must pay yourself a reasonable salary. The IRS doesn't define a specific dollar amount, but they are very clear that the salary must reflect what you'd pay someone else to do the work you do. It cannot be artificially low just to minimize payroll taxes. The IRS has audited and won cases against S-Corp owners who paid themselves $0 or a $10,000 salary while taking $200,000 in distributions. They treat the entire distribution as wages in those cases, and they add penalties on top. So what is reasonable? The IRS looks at factors like comparable wages for similar roles in your industry, your hours worked, your geographic market, and what your business generates. A useful benchmark: the Bureau of Labor Statistics Occupational Employment and Wage Statistics data, which many CPAs use to anchor reasonable salary determinations. For a freelance graphic designer in 2025, median wages were around $58,000 according to BLS data. For a freelance software developer, median wages were considerably higher, around $130,000. Your reasonable salary floor is somewhere in that territory for your specific role. My take: underpaying yourself to juice the distribution split is short-term thinking. The IRS has an entire initiative focused on S-Corp officer compensation. A bad audit can unwind multiple years of savings instantly. Set your salary at a defensible number, one you could justify to an auditor with comparable wage data, and let the distribution benefit work on what's left. That's the playbook. There's another edge case that trips up a lot of freelancers who switch to S-Corp mid-year. When you make the S-Corp election, it's not retroactive by default. The IRS allows late elections under Revenue Procedure 2013-30, but that relief has limits. The cleanest approach is to elect S-Corp status at the start of a tax year, or plan the election for January 1st of the following year. If you're reading this in mid-2026, your clean window for a January 1st, 2027 effective election is now. You generally need to file Form 2553 within 2 months and 15 days of the start of the tax year you want it effective, meaning you need to file by March 15 for a calendar year entity starting January 1st. Miss that window and you're waiting another year. Don't wait. One more edge case worth flagging. If you're running an S-Corp and